My dear friends and investors, welcome to the new financial year. As we close the last financial year in the midst of a war between Russia and Ukraine, aren't we all perplexed at the amazing strength that the markets have shown? And well, there has to be a reason why the markets are behaving strong in the face of many challenges that I spoke about last month: the war, the rise in oil prices, the rise in commodity prices, worry about inflation, worries about rising interest rates, and so on and so forth. So we went back to the drawing board and we did a little exercise. We said, let's try and understand if this rise in commodity prices, the rise in oil prices, what potential impact it would have on the earnings. And if you remember last month, we said that potentially speaking, we could see an 8 to 9% impact on earnings. But this month, we did another exercise. We looked at the Nifty companies and the sectors and the weight of all the sectors in the Nifty. And what we found was that almost 75% of the Nifty will have either neutral to positive impact because of rising commodity prices, and only 25% of the Nifty companies will have some sort of a challenge in terms of margins and earnings. Similarly, we did a similar exercise for the BSE 500 companies, and there almost 68% of the BSE 500 companies will have virtually no impact on their earnings. And the reason is very simple. Sectors like IT services, financial services, healthcare, telecom, metals, oil and gas have virtually no impact, or actually a beneficial impact, because of rising commodity prices. The only sectors where there could be a potential challenge could be in automobiles, cement, and FMCG, right? And therefore, I think the strength of the market is reflecting the fact that almost 65 to 70% of even a broader index like BSE 500 should have very little impact on earnings. We are also seeing that discretionary spending is beginning to rise fast. As we exit the third wave of Omicron, we are seeing activity levels zoom. Today, whether you look at holidays, travel, recreation, movies, people going out to restaurants, we are seeing a massive spike. And some of these sectors which really got impacted over the last couple of years are likely to do exceedingly well over the next 2 years. And I'll talk about that how we have positioned some of our portfolios in companies which we think will benefit as we exit the Omicron wave. And especially consumption at the higher end and discretionary consumption is starting to do phenomenally well. However, we are seeing some stress at the lower end consumption basket, right? Because of the huge inflation that we see in day-to-day consumption items of food, staples, biscuits, tea, coffee. We've seen a massive inflation there. And there we believe that consumption at the lower end of the economy has really got impacted. However, there is a silver lining to this, which is that if you look at the agri commodities, you will find that there is massive price increases in agri commodities. And what it means is that our farmers will have very good cash flows in the Kharif and the Rabi season in 2023. Obviously, we will have to wait and see how the monsoons play out. But if you look at some of the agricultural commodity prices, for example, barley is up 76%, cotton, which is a very large crop in India, is up 61%, maize is up 43%, soybean is up 36%, mustard is up 30%, wheat is up 14%, rice is up 8%. What it means really is that the farmers are going to see a significant increase in the produce prices this agricultural season. And one other important aspect is that today the price of many of these agricultural products that I spoke about are much higher than the MSP or the minimum support price. This is the price at which the government procures food grains and agricultural products from the farmers. For example, cotton. Today, the current market price of cotton is 63% higher than the minimum support price. Similarly, soybean is 70% higher, mustard is 30% plus higher. And therefore, it means that this year we will see additional sowing which will happen. Already, data shows that the acreage under sowing has gone up by almost 6%, which means that 1 year out, as these higher agricultural product prices and the cash flows come to the farmers, this should also trigger the demand at the bottom of the pyramid. Yes, it will take 6 to 9 months to 12 months, but the weakness that we are seeing at the bottom of the pyramid should get addressed by very strong commodity prices. We are also seeing strong reservoir water levels. We've obviously talked about great crop prices, which is also giving an opportunity for booming exports in agricultural products as well. And therefore, I believe that cash flows should improve. This improvement in cash flows should result in increased demand. Increased demand should result in higher capacity utilization. Higher capacity utilization should kickstart the capex revival in the country. Already, data shows that the largest corporates have announced more than 30 billion rupees of new capex plans. The total private sector announcement of new projects is at a record 8 trillion, which means that over the next couple of years, we should see private investments and capex kick off in a big way. As a result of which, we believe that the markets are already positioning themselves for a strong revival of the economy. We should hopefully get the full year this time in 22-23 without any disruptions. And therefore, our portfolios, both the Alchemy High Growth and the Select portfolios, are extremely well positioned. If you look at the psychographics of both these portfolios, you will see that the underlying earnings growth in 23 for high growth is almost about 42% and 48% for the Select stock portfolio. And then in 24, another 24% and 27% earnings growth. So we are basically looking at somewhere between a 40+% and a 20+% earnings growth of the underlying portfolio. Also, the quality of our underlying companies in the portfolio has improved substantially. The ROEs are well in excess of 20% plus, and we believe that we are extremely well positioned in sectors that either have very little impact on earnings because of higher commodity prices or are benefiting from the opening up of the economy, and we are positioned in stocks that we believe will benefit very, very strongly from the uptick in the economy. So despite the clouds that we see around us and hoping that the war doesn't escalate and comes to a logical conclusion over the next few months and there are no more disruptions, we believe that we are looking for, just like we ended 22 on a very strong note, I'm fairly confident that with the way our portfolios are positioned, we will end FY23 with an even stronger note. So with that, I bid you adieu for this month, and until we catch up the next month, there will be a lot for us to talk about as the earnings season will be well underway, and we will let you know how the progress of our underlying companies is happening as the Q4 results start to roll out in April and May. Thank you once again. Until we catch up again. Bye.